Zero will be your hero. In this episode, I'm going to address the question, how does IUL, Indexed Universal Life, not lose money when the market crashes? One of my favorite topics. Get ready. You're going to be blown away. So my name's Doug Andrew, and what do I know? Well, I've been around the block for quite a while. I started in 1974 in the financial services industry. I got my Series 1 securities license that year and my insurance license. And I've never looked back. From 1974 to 1980, I sold a ton of life insurance. It was a term to 65 with an annuity rider, which people could just be satisfied with a 7 or 8.5% rate of return on that, which sounds pretty good today, but back then that was just sort of ho-hum. And they could then assign out the annuity cash values every 90 days into a mutual fund of their choice to try to earn higher returns than 8%, which many people did. But we realized that even if you could earn 12%, at the end of the day, you're going to have to pay tax on that sooner or later, even if that was a tax-deferred IRA or 401k, which means if you earn 12, you're only really netting 8% after paying federal and state tax. And a lot of asset managers charge 1% in fees. So you'd have to earn 11 to net 7. And that's why E.F. Hutton, who was not an insurance company, okay, they were a brokerage firm, said, what are we thinking? Let's just earn 11 and net 10 by putting money into an insurance policy, but let's structure the insurance policy by using the least amount of insurance the IRS will let us get away with and put in the most premium the IRS allows as fast as they allow, and this turned into a tax-free cash cow. Universal Life was designed for living benefits, primarily, not for death benefit, whereas whole life, you can use it. Whole life had to become more competitive to compete with Universal Life. But see, whole life was primarily built on a chassis for death benefit. So it's okay for death benefit, but if you're using insurance for tax-free accumulation and then tax-free income, a properly structured maximum funded Universal Life policy will knock the socks off of the same income taken out of a whole life policy, and I can prove that to you all day long. There's a lot of whole life agents that do not understand this, so they don't believe it. Well, I've seen it work now for more than 4 decades because I've been around the block and I've owned Universal Life and I've helped many, many thousands of people set up their own policies to perform as an incredible capital accumulation tool for all kinds of financial goals. People say, well, Doug, you've been using Indexed Universal Life since 1997 because before that, you just had your money inside the insurance policy, which was not affected during market crashes. So back in 1980, I had 3,000 clients in 13 Western states that I was responsible for. They were never happier than when I got them out of that volatile market into Universal Life. But see, in the 1990s, interest rates started to come down, and that's when in 1997, ING was the first company that introduced Indexed Universal Life. Let me explain what that is, but before doing so, if this is already intriguing you and you can think of somebody who ought to watch this episode, be sure and share, post a comment, click like, but most importantly, subscribe. It's free. And when you subscribe to this Three-Dimensional Wealth channel, be sure and click that little bell because then you'll be notified every time I post a new video episode, which I do almost on a daily basis. I don't want you to miss out. But stay with me to the end because I want to gift you a copy of my most recent best-selling 300-page book, The Laser Fund. You don't need to pay $20. You can claim your free copy, so stay with me. So how does IUL not lose when there's a market crash, especially using Indexed Universal Life? It allows you to participate when the market goes up, but not lose when the market goes down. You may not make anything. You may make zero, but you don't lose money due to market volatility. So zero can be your hero in those years when a lot of people who have their money in the market lose 20, 30, 40% like people did in the Great Recession. Many Americans that had $1 million by the year 2000 in tax-deferred IRAs or 401ks invested in the market saw that $1 million nest egg dwindle in value from 2001 to 2003 down to 600,000. They lost 40%. A 40% loss has to be followed by a 67% gain to get back to break even. 67% of 600 is 400,000, okay? And so it took 4 years to make back what they lost and get back to break even in 2007. And then what happened in 2008? For the second time in a decade, people lost 40% again. And it took 4 years until 2012 to make back what they lost. Now, our clients using indexed universal life, in 2001 to 2003, they didn't lose anything. They may not have made very much, but they didn't lose. They were almost like, go, go. And as soon as the market turned around in 2003, they picked up where they left off at their million, let's say, instead of going clear down to 600,000. Same thing happened in 2008. It dropped 40%. America was going crazy. They had money in the market. Our clients weren't going crazy. They sat there with calmness. Go, go. Because when it turned around in 2009, most of our clients locked in gains of 16% tax-free. The first 90 days of 2009 after not losing a dime. Zero was their hero in 2008 because most Americans lost 40% for the second time in that decade. So that's what I mean by zero can be your hero. So I'm going to use a simple example here. Let's say you've been socking away $500 a month into a universal life policy for 30 years and it now is grown to $1 million. Or maybe you threw in $500,000 over a 5-year period and now that $500,000 has doubled to $1 million in the last 7.5 years, which has happened for many, many clients of mine who started a universal life at age 60 or 65. So let's take a snapshot in time. You've got $1 million of cash value in your policy. So here we go. I'm going to super simplify. I've got $1 million of cash value, let's say at this point in time. And whether I'm taking out income tax-free or I'm letting it sit there and grow tax-free doesn't matter. So my $1 million is safely tucked in the insurance company. These are legal reserve insurance companies that weathered the Great Depression with flying colors. Banks closed, 40% never reopened their doors again. Some real estate dropped 80% of the Great Depression. There wasn't one legal reserve insurance company that went under in the Great Depression. They usually came through crediting 2.5%, 3%. Same thing happened in 2008. Not one single legal reserve insurance company went under. One or two became temporarily insolvent because they couldn't call all their loans due because insurance companies, they don't invest very much money in the market, in the stock market. What they do is they loan money on skyscrapers and shopping malls at about 50% loan to value. If they have to foreclose, they come out smelling like a rose. They buy AAA and AA bonds and so forth. So they earn on conservative investments what is called a general account portfolio rate. Back in the 1980s, I never earned less than 11.75% on my universal life, as high as 15.5%. But in the 90s, interest rates started to come down, so they came out with indexed universal life. What's that? You can settle for the general account portfolio rate anytime you feel bearish about America. So if I have $1 million and I feel like, oh, we're headed for another recession, just settle for the general account portfolio rate. Right now, as of the recording of this episode, that might be 4%. Now, that's not fabulous, but it's 4 times what banks are paying right now. So you may want to just earn 4% or $40,000 on that million, and it's tax-free. Or if you feel bullish about America, you think the economy is going to go up, you can link your return on some or all of that million to an index or indices you can diversify of your choice that company offers. Let's simplify this. Let's say you choose the S&P 500. You're not telling the insurance company to take your $1 million and invest it in the S&P in the market. No, your million has to stay safe in the insurance company earning 4%. And I'm talking about this is 4%, maybe net to you. That's $40,000. What you're giving up is that $40,000 being credited to your account. You're relinquishing the interest, but your million has to stay safe. So what does the insurance company do with that $40,000? That $40,000, they use it to buy upside options in an options budget. in whatever index or indices you chose. Let's say the S&P 500. So if the S&P goes up, that 40,000 of options give them the wherewithal to pay you 8% or 12%, or some years, like the year of this recording, many people lock in gains of 61.33% by using a no-cap strategy that year. Well, that means that during that year, the insurance company can afford to pay it because those options allow them to do that. But what if the market crashes? You guessed wrong. Well, the options expire worthless, but your million is still safe. You didn't lose one dime of your principal. And as Will Rogers once said, people get more concerned about the return of their money instead of the return on their money when things get bad. So that is why zero is your hero. If the options expire worthless because the market crashes, you didn't make anything, but you didn't lose any of your principal. You just sort of relinquished the interest that year. But I've learned that by using indexed universal life, you'll usually earn about 2.5% greater rate of return than just sitting back and accepting the general account portfolio rate, which allows me historically to move from about 7.5 or 8% up to as much as 9.5 to 10% rates of return by using indexed universal life and not lose when the market crashes. So here's my recommendation. If this is new to you, be sure and learn more. I don't want you to miss out and be left in the dust, because you can set aside your serious cash for long-term goals, retirement, college funding for your children or grandchildren, because a properly structured maximum funded universal life policy will knock the socks off of a 529 plan. You can use it as an emergency fund, a working capital for business, or real estate management. But as you put money in, and during the volatile markets, and they're going to continue, I assure you, when the market goes down, you can be calm. You may not make much of anything. Zero may be your hero, but you will not lose the principal that you started with. You pick up where you left off and you lock in gains every year and you reset. If you don't understand that term, search this channel for that concept. But here's where you can learn more. I want to gift you a copy of this 300-page book. It's been flying off of our warehouse shelves. We send out hundreds of these every month. It's called thelaserfund.com, Laser Liquid Asset Safely Earning Returns. This is a properly structured maximum funded indexed universal life policy. When you structure it correctly, it can be called a laser fund. So to learn more, I want you to read and learn. Go to laserfund.com, click on the link below. You contribute just a nominal amount towards the shipping and handling. I'll cover the rest of that, and I'll pay for the book. This is 300 pages between this side, 200 pages, the charts and graphs, and this side that has 62 actual client stories. I want you to learn, but while you're in there, if you like to listen and learn or watch and learn, there's options there to join us for webinars, educational events. Check out Retire by Design, RBD. That's a 6-hour virtual class we teach at least once a month. But here is to your brighter future.